Remember at your parents' house in Austin? First time I went over there, I go into your dad's study and I'm looking at his books and there's like a picture of your sister with Alan Greenspan. And I was like, is this your sister with Greenspan?
This is Mr. Allen.
You were like, yeah.
Just Mr.
Oh,
Allen
yeah.
in the 90s.
All right, let's do this.
Let's go. All right, on crashes, we study market cycles with a specific focus on market crashes, otherwise known as bear markets. A bear market is when a market is down at least 20% peak to trough. I'm Matt Harris, and I'm the founder of a venture-backed startup called Architar. Prior to founding Architar, I spent 15 years in the investment world, 10 as a mezzanine investor at the Blackstone Group, and 5 as a principal at a Silicon Valley-based venture firm called Draper Associates. I'm based about 45 minutes north of New York City in Ridgefield, Connecticut.
I'm Daniel Gamboa, and I led investment operations at Divvy Homes until we sold to Brookfield earlier this year. I've worked across engineering, product, and finance at several high-growth startups, and I'm based in Houston, Texas.
Today, first episode of Crashes. We're studying the 1992 to 2000 expansion period and the 2000-2002 bear market. So we decided to start here because our take is that this is where modern markets really started. You know, like before this, it wasn't long before this, before private equity became like a big business. It wasn't long before this that hedge funds kind of started to show up. You know, same with venture capital. This is really when the retail investor became a big part of capital markets. This is when the modern sort of media machine became a part of the markets. And so that, plus the fact that most of the most dominant companies today either started or really transformed themselves during the period we're going to study today. And so it's just a really interesting place to start this kind of crusade that we're on at Crashes to study every market crash that's ever happened in history. And then second is, I think there's just a lot of interest in comparing the current period to this period. So there's a little bit of history rhymes that I think just creates some intrigue around this time. So that's why we're starting Crashes with this time period. And then, what do I mean when I say we study market cycles, specifically the crash part of market cycles? So there are 3 parts to a market cycle. There's a bear market. They're usually caused by a recession. There is a recovery where the market recovers back to its previous high. Then there's an expansion where the market expands beyond its previous high until the next bear market. So just to quote some stats to help everybody level set, the typical bear market lasts on average, bear markets since the end of World War II have averaged about 13 months. Typical recovery period since World War II has averaged 23 months. And the typical expansion period has averaged 33 months since World War II, which is really interesting, right? Like recoveries and expansions are 2 times and then almost 3 times as long as bear markets. I think from the perspective of what we're studying here, it's really interesting because you have an expansion period that was 109 months long. This is the longest expansion period on record since the end of World War II. And then immediately following it, you have a bear market period that's 31 months long, and it's the second longest on record since World War II. So you have super long expansion and bear market periods that we're studying here, where the gains and losses in aggregate, because they're so long, are really dramatic. And so that's kind of the setup of market cycles. So rather than thinking about things on an annual basis or on a decade basis, we're really taking a market cycle approach where, the expansion prior to this one was following the 1987 huge market crash, which we'll talk about, which is a major kind of factor throughout this period, where the market expanded from 1989 to 1990. So that was just a 12-month expansion, and it was weak. It looks like the S&P annual return was 8%. In that expansionary period, when it actually averages 17% in expansions. And then we had a recession caused by the Gulf War and the initial uncertainty around that. This market cycle we're studying really started in February of 1990 in terms of the expansion period. It didn't really get going until 95. We'll talk about how the Netscape IPO is what really kind of kicked this stuff off. But so leading up to the really key things, I think, leading up to that part of the market, right, the 1995 part, where you have to go all the way back to the late 70s, early 80s, when inflation and interest rates peaked kind of in the 20% area, and then proceeded to fall, for 40 years all the way to 2020. And so we're in that sort of macro picture, and you're just coming out of a super volatile time as you head into the 80s. Or the early 80s were tough, but the 80s in general were pretty strong, kind of all the way up to 1987. Where you had the largest single day fall for the S&P on record at over 20% in a single day. Alan Greenspan was the head of the Fed at that time, just like he was through the 90s. So there's a lot of stuff we'll talk about there. And then as you get into the 90s, you have a kind of a short bear market in the early 90s, and then an expansion starts in 91. The markets were particularly weak at the beginning of that expansion. 92, 93, 94, you had the S&P up 4.5%, 7%, and then down actually 94, 1.5%, because the Fed, I think they did 3 hikes in 94, because they saw, when you look at the inflation numbers, stuff was kind of starting to tick up to the 4% area that year. So they actually hiked rates 3 times at the beginning of an expansion. So there's the market backdrop of, what were returns and what were rates and all that stuff. But then there's a whole other angle about like what was going on kind of culturally at the time and how that impacted markets. And so to me, the 4 things that I noticed in my study from a cultural perspective that impacted markets were: 1, the end of the Cold War, right? What did you kind of notice when you...
What I read a lot about is that people were very optimistic. I think the general consensus was that capitalism had won. The US model had won out. Everybody was pushing ahead, and the US was going to lead the world into kind of this next stage. It was the end of history, so to speak. And that was like the mindset from everybody.
Yep. And I think it's hard. I think it's hard for us today to imagine that this the early 90s may have been the first time that most people felt safe in the world since the 30s, which is kind of wild to think about. But because you had World War II, which really, the Cold War really started as World War II ended.
I mean, even if you go backwards, right? Like even if you go back to the early 1900s and World War I and the flu pandemic and then everything that came after that with the 20s and then the 30s, it didn't feel like the world was pretty fragmented.
Yep.
There's a lot of conflict in the world all the way up until 1990, basically.
Yeah, and so the collapse of the Soviet Union really gave democracies and capitalist societies the confidence that they had been right all along. They had won. This was the final form of kind of physical human government. So much so that a couple things I read that people said, with the fall of the Soviet Union, we've conquered the physical world, and like, where are we going to go next? And the thinking was the digital world is where we're going next. And so that was a major factor just in everything, right? Like free markets and all that stuff was all throughout policies and the way people were acting in markets. And it was very big in Alan Greenspan's thinking.
Yep.
The second thing culturally that I think was a really big deal was what was going on in just academia, where basically my read is that as we kind of got into the 80s and approached the 90s, investing started to be thought of more as a science than an art. There was a view that it had been figured out. From the perspective of academia, you had things like the Sharpe ratio, right, which can calculate the risk-adjusted return for any asset class. Yep. You had the efficient market hypothesis. You had kind of all the stuff around portfolio diversification and Markowitz. And one of my favorite books, actually, Stocks for the Long Run. Jeremy Siegel does this study going back a really long time, where he basically shows that a diversified portfolio of stocks never does poorly over a 10-year period, and is actually less risky than bonds. When you compare this to the even the 70s, right? Like before this, my understanding is that in the 70s, people didn't even know that, for example, bonds should return less than equities, right? Mm-hmm. People didn't understand. They just didn't have that data. And so we're just in a totally different paradigm where the summary of all the academic findings was buy and hold a diversified portfolio of stocks.
Well, I guess, and we'll get into this, I'm assuming, but, with 401ks, kicking off and major index funds kicking off, and there's that documentary Tune Out the Noise by Dimensional that I think is really good for this period. I think the amount of capital flows that are going to come into the market from people because they absorb that philosophy is going to be pretty huge.
Yeah, we'll talk about that. It's massive. And it also had a really big hand in the long-term capital management fund that caused a major panic and correction in late 98 that we'll talk about. The third kind of major thing that I think was on people's minds from a cultural perspective, which is kind of the backdrop to this situation, was the 1987 market crash, which we'll study in depth on another episode. I think the two major ways that this contributed to the period that we're studying is, one, I think Alan Greenspan learned that he can react after a market collapse rather than before to right things. And then the further Further back history of this, another crash we'll inevitably study is in the Great Depression, the Fed raised rates to pop a market bubble, and that some people think that caused or contributed to the Great Depression. And so you have this sort of baggage around how to deal with stock market bubbles. And one of the things that legislators and regulators were kind of yelling at Alan Greenspan later in the cycle when he was raising rates was there is no correlation between inflation and stock market prices, and so it's a really interesting dilemma when you have a stock market bubble from a policy perspective. The second way I think that crash impacted the way people were thinking about markets throughout the 90s was that it was super scary and really volatile, but they learned to just hold. They learned to not sell because it's going to be fine. And then the fourth sort of cultural backdrop thing, this kind of maybe goes to the feeling safe component. But to me, one of the most telling visualizations of the period, this is a little nerdy, but if you look at a 10-year...
this is all a little...
If you look at the 10-year moving average and one standard deviation around the 10-year moving average for GDP and inflation, it's coming into this period, it's like super wide and very volatile. And then at the start of the 90s, it just becomes like real thin and flat for like a decade straight. Right, and so the summary is you had this period of falling interest rates, low volatility, strong growth, so much so that the words new economy became very common, like they had been used in the 20s.
So say that again. You're talking about spreads. What becomes thin?
I'm saying that so prior to this period, if you looked at GDP and inflation, which are really, you can use those two metrics to kind of abstract every other piece of economic data. If you looked at the standard deviation of those data points, it was very wide, right? Meaning that we were in a very volatile period with very high numbers and low numbers for these metrics.
So like you would have 1 year of high GDP growth, the next year would be low GDP growth. You're saying it gets really tight, like it's
and in the 90s, and it's relevant because it's if you look at it on a 10-year moving average, right as you enter the 90s, which is probably like roughly how far back people are thinking. They're for the first time, they're like, okay, we're in a stable period, and we've been in a stable period for the last 10 years. For the first time in everybody's memory.
Yeah.
And for people with, we'll get into this, but for people that were, around in the late 70s, early 80s, the idea that we could grow at the rates that we're seeing in the 90s and have the unemployment rates that we're seeing in the 90s without inflation was like unthinkable, right? It was against the way people thought about how the economy worked. So that's kind of why it was termed new economy and miracle and all that stuff. That's kind of the market backdrop and the cultural backdrop. But I think anything you'd add to that?
The only thing I was going to add that's sort of a fun quote that I found, which is very related to this, is that, and it's probably a good segue to technology and what was happening with the tech, is that nothing important happens without crashes. That was a Fred Wilson quote. So one of the things that was really interesting with this is that it seems to me, after having read all these books and all these research papers, that one of the core themes of this story is that the 90s are a huge inflection point in terms of where the economy goes. So we were coming from a world where the biggest companies in the world were industrial companies. If you look by market cap, you've got companies like GM, Ford, Exxon, GE. Like those are companies that dominate the stock market. They're the biggest companies in the world. And we're transitioning during the 90s. And this wasn't obvious back then, and it didn't really become the thing until probably the 2010s. So we went through a transition. But the 90s really are the inflection point where we start to transition from an economy that is very industrial to an economy that's very technology driven. So if we back up, there are two key technologies that set the stage for the dot-com bubble. So the first one is the personal computer. And the cast of characters here, the sort of Apple story with Steve Wozniak and Steve Jobs, and then the Bill Gates story. And there's a lot of other players, but before the PC, computers were mainframes. They were the size of rooms. They were mostly used by the government for defense. They were used by research labs. It's nowhere near what we have today where everybody kind of has their own computer. And the invention of the microprocessor kind of unlocks that. And, you could buy these components and you can build desktop machines. And that's kind of what Wozniak does, right? He builds a hobbyist machine to play games that you can fit on your desk. And so that 1976, Steve Wozniak, Steve Jobs launched the Apple I. 1977, they launched the Apple II. And they kind of fully productized it, right? The Apple I was a pretty raw version of a product, but the Apple II is the first fully productized version of a personal computer. And then IBM launches the PC, or their version of the PC, in 1981. And that sets the standard for what's to come. and businesses started adopting the paradigm, right? You can't go wrong with IBM, and we're kind of off to the races. What we think of today as like the standard, graphical interface doesn't really come until much later. So 1984 is when the Macintosh gets launched, and then later Windows comes out. And then at that point, PCs really start going from novelties that people more or less see as toys to fully functional computers that get adopted by businesses. So these are now like enterprise grade computers. They have spreadsheets, and people start using them. So some growth statistics. So in 1981, there were only about 2 million personal computers. Sales were doubling year over year for a couple of years through 1982, 1983. By 1990, we're going to have 54 million. So that's, basically like half of the households in the US have a personal computer. So we're basically entering the 90s with really easy to use computers, graphical interfaces, applications for productivity everywhere, word processors, spreadsheets, graphics programs. And, they're not communication tools yet. They're really kind of like just productivity tools, but they're everywhere. And people kind of understand this. It's really kind of capture the consumer and the business market. So that's technology number one. The second technology is, of course, the web. And so the cast of characters there are people like JCR Licklider, who had been working at ARPA and on ARPANET and had a lot of ideas about how to make computers augment humans. Tim Berners-Lee, which we'll talk more about here in a minute. And then, of course, Mark Andreessen and Jim Clark. Again, the internet. So the idea that you would want to connect computers so they could talk to each other was pretty common. A lot of people were talking about this, at least in research circles. And they had been thinking about how you might do this, even in the 60s. 1969, they sent the first message from one computer to another. It actually was a computer at UCLA and a computer at Stanford using the ARPANET. And so ARPA is, modern day DARPA, which is the Defense Advanced Research Projects Agency from the Department of Defense in the US. The main reason why they were building this is they wanted to facilitate resource sharing and collaboration. And so there's sort of like, there's a secondary use of like, nuclear resiliency and stuff like that people talk about. But really the primary reason, if you go back to the research papers and read what Licklider was writing about, they were really concerned with just how do you facilitate resource sharing and how do you kind of accelerate research collaboration across all these different labs and teams. ARPANET keeps growing. By 1972, there were 37 computers that were hooked up, mostly for email and like file sharing. And then in 1983, they went from a kind of simple networking architecture to a more robust kind of network of networks. So basically the protocol for communication became much more sophisticated, and you could link up a bunch more computers. So at this point, and for most of the 80s, internet was basically text and file sharing, and there were academics on it and researchers. But then Tim Berners-Lee, who's a computer scientist working at CERN, which is a big particle accelerator in Europe, builds what he calls the World Wide Web. And so this is basically documents, so kind of web pages basically, that are accessible via the internet. And he creates a web browser to access the pages and a web server to serve these up. And so again, this is all text only. There's no images. This is really kind of just designed for research purposes. But of course, people start tinkering. He releases it. People start tinkering and hacking away and playing with the tech. And one of those people is Mark Andreessen. And so at this point, he's a student. This is 1993. He's a student at the University of Illinois. And he's part of a team that is building a browser. And the browser is not just about text, but also with images, among other things. And the web starts to get traction. Anybody who's watching closely and, has like half a sense of vision starts to see that this thing, if you extrapolate, should be really huge. This should revolutionize communication. Again, no search engines, just forums, directories, that sort of thing, links. No videos, mostly text, some images, lots of limits on bandwidth, dial-up modems that some of us can remember with the funny noises. But by 1993, really the seeds of the web have been sown, and it's a fertile market, right? Because everybody has adopted personal computers, so there's a lot of personal computers out there. But there's one piece missing, and anybody who's been paying attention to crypto or AI over the last couple of years knows this, which is you need an on-ramp. You need a way for people to actually use the tech. And so enter the story of AOL and other kind of platform companies. So this is really the last piece to put in place from a technological perspective. And AOL was a company that started in the 80s as a way to kind of to download games. So basically, they had a proprietary network. It was not the web, so this is just an AOL network, and people could download games from it. And they ran forums where people could kind of talk to each other and things like that. But then you fast forward into the early 90s, and it starts to become clear that the open web, not these walled gardens, is taking off. And so online servers with closed networks are going to move to providing access to the web instead. So AOL was behind, but they basically carpet bombed the market. And again, people that were around back then, even as kids like me, you remember the CDs that were everywhere, and AOL starts to take the lead spot. More importantly, the idea of the web starts to gain traction, with the general public. And so we're moving kind of well beyond computer people and researchers, and this is kind of feeding into the public zeitgeist, and they become the on-ramp for the internet. So a lot of people start getting online through AOL. So by 1995, all the ingredients are in place for a massive boom. You've got the personal computer widely adopted. You've got the web that's in place. People start talking about the information superhighway, and politicians start using that phrase. So when the politicians start paying attention that this is really kind of filtered into the culture. And then there's really easy to use affordable on-ramps for people to access the web. So everything is there. Entrepreneurs and investors start lining up to fund some of this stuff. There's kind of a huge wave of investment and betting that's coming. You didn't need tons of capital, which is a critical part of this, right? This was kind of permissionless before permissionless was a word. You could just build something and put it out there and have access to a massive market. And people start to notice, and people like Mark and others that are technology forward are there to kind of take a shot and see what they can build. So bit of a tinderbox at this point, but no Spark yet.
So what was your screen name, and when was the first time you chatted on AIM?
I was late to the game because I didn't join till like 8th grade. My screen name was Daniel, VNZLA, because I'm from Venezuela. And I felt like, yeah, that would be cool, until like much later on, once I was already locked into that screen name, I realized like that's a hard thing to spell. Like people don't even know what that stands for. So not a great screen name.
You probably could have got Daniel Venezuela back then.
Probably, yeah. I don't know if I tried, yeah, but not. It's the abbreviation of Venezuela. It didn't age well. What was yours?
My screen name was MattDog28, DAWG.
Sounds right.
And I actually have a very distinct memory of in late 4th grade. Everything finally getting connected. And I was a little after most of my friends. I remember that's why I was like eager to get on there and chat. I remember everything getting connected, and my dad walking out of the room, and me being like, just feeling, this kind of freedom to do whatever I want. Yeah.
Did you use the little like profile building things where you could like color the background?
That was a big deal.
Yeah, that was a big deal.
Profiles,
you had to do that. Yeah. Make it your own.
Some things that you said are, I think, worth highlighting when it comes back to zeitgeist, right? When it comes back to the thinking of, kind of the dominance of capitalism and free markets. Because some things happened in the progression of technology that were very, very free market oriented. One, for example, like Tim Berners-Lee, the thing that he brought into the world was HTTP, HTML, which is like hypertext links, like how you travel from website to website.
Yeah,
it like makes sense.
Yep.
And CERN actually owned the rights to that, right? And they actually released the rights to the world, which is like a very free markets thing to do.
Yeah, I think the open source movement is a really critical piece of all of this. Like that was definitely a part of the culture that informed everything that came afterwards. And you had Microsoft on the other side, right? Most of the 80s and into the 90s, kind of beating the drum against the open source movement. Like you got to get paid for software, otherwise nobody's going to build it.
Yep. And then you also had a period where, so in the late 80s, Congress approved the construction of essentially a second network to ARPANET being the first network. The second network was NSF-Net, and the operating contract for NSF-Net it expired, I think in the late 80s or early 90s. And there was like a very, very specific push to privatize it, right? To like let private companies take over the operations of the internet, which is that's like a very free market thing to do.
Yeah, we should say NSF-Net, National Science Foundation Net, which is like the scientific community was using this thing.
Yeah, I think for a long time you could only use it for like research and science. Yeah. There was like I don't know how they enforced that, but it was like,
yeah, well, I think it was just who had access. Like you just didn't have access if you weren't part of that community.
Yep. And then, we'll get into this more, but just to hit on it in the beginning, as you think about the build out of technology in this cycle, I mean, I think for me, if there were like three things to summarize about this time period, one of them would be that like we saw a major productivity enhancement in this expansionary period, especially the second half of it, which I think is super important to highlight because we hadn't seen good productivity numbers since the 60s. I think it was like 71, the 70s to the early 90s. Like our productivity was like less than 1.5% a year. When prior to that, it had been very high. Productivity is relevant because it's the main thing that drives quality of life. And then in the late 90s, we started to see like not quite sort of pre 70s productivity numbers, but much higher than they had been. About I think it was like 3% per year versus 1.5% prior and 4.5% kind of in the post World War II period. And I'm curious what you saw, but if like I think the thing that caused the productivity was capital deepening was the word I saw when I read around, which is essentially the visualization I have in my mind, at least, is it's the surrounding of the worker with technology tools to be more productive, and all the capex that was associated with
like tools and resources, not like financial capital.
yeah, like I think it was the surround like it was two things. It was the surrounding of the worker with just much more the ability to be much more productive, and then the things that the worker was surrounded with also themselves increased in productivity. Like that was kind of my takeaway.
Yeah, that was my takeaway too. Yeah, and it's sort of intuitive, but I think the one interesting piece is that people were expecting it, but they weren't it didn't get recognized right away. Like I think for a while there, people were wondering where is the productivity.
Yeah, I think all the way up until about 95, 96, one of the things people talked about a lot was the productivity paradox, right? Because the personal computing stuff started in the mid 80s, really, right? So you really had like a full decade of people thinking you were going to get this big productivity enhancement, and then it went away.
Show up.
And one thing I think is interesting that we'll study, on another podcast is that this productivity enhancement didn't last very long. Mm-hmm. This is I forget. One of the famous VCs said, we thought we were going to get flying cars, but we got 60 characters or whatever. And so we'll talk about that more. But I think in the technological lead up, you're starting to see the capital deepening that really catches on fire in the late 90s when you add just a ton of capex on just telecom infrastructure.
Yeah. Which is sort of, I think, part of the reason why it was hard to see at the time, and especially when we get into the bubble bursting and everybody kind of becoming more pessimistic. There's all this stuff that gets put in place that doesn't get fully utilized until basically like the late 2000s, early 2010s. But this really sets the stage for all that productivity that's going to come later, and for the massive sort of market expansion that's going to happen, up until now.
Yep. And this is one of the major parallels to the current time period is that the technology the way it's acting right now is similar, right? We're spending a ton of capex on the sort of AI and data center build out. Market valuations are kind of in the same area, and those are probably the two things that are most similar.
We've got the backdrop of the markets. Everybody's really positive. The Berlin Wall fell. New investments. We've got the personal computer adoption. We've got the web. We've got on-ramps. There's a bright-eyed 22-year-old, Mark Andreessen. He's working a boring job. And remember, he had built the Mosaic browser at the University of Illinois, and then he had moved to California. And so he gets a cold email from Jim Clark. And there's a whole book about this that we both studied called The New Thing, where Jim Clark is kind of the protagonist. But he reaches out to Mark Andreessen and he says, hey, left Silicon Graphics. By this point, Jim Clark is kind of a major player in Silicon Valley. And I think it's worth saying too, just to kind of set the character a little bit, that Jim Clark is like an engineer's engineer. Like he's the kind of guy, especially during this time period, which is not at all like it is today. He loves the idea of engineers being in charge. Like those are the builders, those are the people that should be in charge. Those are the people that know how to navigate, technological paradigm shifts. And at this time, that's not the case, right? Like most companies are led by like organization men, by like business guys, and you bring in the adults, when you start a company and it gets going. And Jim Clark hates that stuff. So anyway, he leaves Silicon Graphics, which is kind of a whole story unto itself. But he leaves Silicon Graphics and he reaches out to Mark Andreessen. Mark gets this email. He, of course, jumps at it. This would be like getting an email from Pioneer. I was thinking the guys that I was thinking about, Kevin Systrom comes to mind from Instagram. Like I feel like that would be an interesting comp, or even like Jeffrey Hinton of like deep learning fame, somebody like that, because Jim Clark was also a professor at Stanford. So anyway, Mark jumps on it. They get together. They start brainstorming, and Mark convinces Jim that the most compelling product that they should go after, the most compelling thing they should build, is a next generation browser, which of course is what Mark knows, and he calls it Mosaic done right. So they start Mosaic Communications Core, soon to be renamed to Netscape, on April 1994. So they fly to the University of Illinois. They recruit Mark's team from the original Mosaic, and they start building. And they decide to give it away for free. They kind of set the tone for the philosophy that's going to come, with the dot-com boom of build distribution and figure out monetization later. And they want to make it ubiquitous. They sell server software and enterprise support, and they try to establish Netscape, the browser, as a standard, and they kind of try to become the operating system of the web. And it sort of worked over the first couple of months. The first 4 months, they have 75% of internet users are using the internet on Netscape, and revenue is really tiny, but it's doubling every quarter, so huge growth. And they decide to capitalize. And with the company barely a year old, so now fast forwarding to 1995, August 1995, they decide to go public. This is the spark. It's an absolute frenzy. They're slated to go public with their bankers at $14 a share. At the last minute, because of demand, they double the price, so $28 a share. And they end up raising $140 million at a valuation of $1 billion. Their revenue is $33 million. So pretty low revenue, pretty high multiple on the valuation. And they actually soar to $75 after opening. So they closed the first day at 58, but at the peak on that first day, they were trading at $75 with a market cap of $2.9 billion. And every single VC in the Valley and every single entrepreneur that's watching this is going, I want some of that. So I'm gonna Netscape. We're gonna come back to Netscape, and I'm gonna talk a little bit about the sort of 800-pound gorilla that dominated technology and was really kind of the up-and-coming sort of dominant company in the world at this time, which is Microsoft. Backing up a little bit, Microsoft in the early 90s, they start betting on walled gardens. So they have this vision for what was called Microsoft Network, MSN. And, there were some inside Microsoft, as it turns out, that were raising flags about the open web in 93 and 94, but Bill Gates was pretty skeptical. He thought it was a fad. And like we said, Microsoft had this philosophy that open source was not the future and should not be the future. And so MSN was going to be a walled garden. And it was going to be from Windows, and it's going to have, it was going to have curated content and discussion boards and stuff like that. But it's kind of a flop. And then on top of that, as Bill Gates starts looking around and sees the adoption of Netscape and everything that's going on there, it sort of like it convinces Bill that this is the way that they have approached this is not going to work. And there's a famous memo that he wrote in May 1995 called "The Internet Tidal Wave." And in that memo, he says that he was struck by the fact that, quote, "It is easier to find information on the web than on the Microsoft corporate network." So basically, this is sort of the equivalent of the code red that Google raised when ChatGPT was published. This is similar. Like Bill inside of Microsoft is saying, like, we can't miss the internet. We can't afford not to be on this wave. This is the biggest threat to the business. And he says, quote, "The internet is a tidal wave. It changes the rules. It is an incredible opportunity as well as an incredible challenge." So in the memo, he basically outlines what Microsoft is going to do. Basically, the only priority is going to be the internet. Everybody working on anything is going to basically pivot into the internet flavor of whatever it is that we're working on. And most important of all, they're going to build a browser. So kind of putting Netscape in their crosshairs. So enter the browser wars. So what
I did not at all appreciate how dominant Microsoft was back this far, right? Like one of the things I read was that at one point in the 90s, 90% of personal computers had Windows.
Yeah.
So they were just completely dominant when it comes to the operating system of personal computers. And that positioned them to win the spreadsheet market, which they did, and to win the doc market, which they did. There were other companies in those spaces that they basically just offered Excel and Microsoft Word for free if you buy the operating system.
Yep.
Which is hard to compete with.
Right. Yeah. And it's funny too, because like the whole strategy, like the whole positioning of Microsoft happens because of that infamous deal with IBM where they can just license the tech instead of selling it to them. So they kept the IP. So anyway, enter the browser wars. And so the browser wars are fascinating because there's a lot of drama. This sort of sets up what comes next for Microsoft, which leads to kind of their lost decade, because this is going to lead to some antitrust stuff. But basically, Microsoft at first actually proposed to Netscape that they divide up the market. Apparently, they had conversations with the Netscape team. Netscape refuses. They said, no, we're going to compete head on. Kind of a bold move. So then, Netscape goes public. The frenzy around it convinces Microsoft that they're for real, and they're very threatened by it. And it's not at all clear at this point that the browser as an operating system analogy is not going to hold up. And so they truly think like the Netscape browser could be a Windows killer, which is like the cash cow at Microsoft. This is the whole business. And so, of course, Netscape is very it's encouraging this. They believe this. That's their whole vision. And they have kind of contempt for Microsoft. I think a lot of people in the Valley at this time had a lot of contempt for Microsoft software, just the quality of the software and sort of the taste of their products, which is sort of, a fair take. But by 96, Microsoft is all in. They bundle a free browser with Windows. So they have massive distribution already across the whole Microsoft customer base. So they dominated 90% of the market. So everybody's getting a free Microsoft browser. What do you need? Netscape. And so basically most of the computers in the world have Internet Explorer. And this was a bit like what we were seeing with LLMs, and everybody's kind of one-upping each other in generative AI today. So Microsoft was kind of like in Google's position, I guess, at the time, and OpenAI is kind of the scrappy Netscape. I think it's not a perfect analogy, but you can kind of think of it that way. There's a lot of partnerships. Microsoft actually ends up partnering with AOL after MSN doesn't really get traction. And so AOL is like the on-ramp inside of the Microsoft ecosystem. Netscape ends up signing a partnership with Yahoo. There's a bunch of these. And then kind of meanwhile, while this is going on, there's a lot of startups that are riding the coattails of Netscape's success. And so there's all this venture capitalists that are jumping in. The VC industry, from what I read, goes from like $1.5 billion in AUM. So very little. That's not even one fund today. Like $1.5 billion total AUM, 91. They were funding like 100 companies a year. Most of them, I think, were focused at the time on like enterprise software and computer hardware. Pretty sober companies with strong business models, that kind of stuff, very buttoned up. And Netscape changes all of that. So startup founders become rock stars. This is sort of like the first step towards the world that we live in today, right? So founders become rock stars. There's fast gains. There's this big wave of opportunity. Everybody's super greedy. And everybody wanted to ride this wave. Everybody wants to get rich. Everybody wants to be on a magazine cover. Mark Andreessen actually is on a magazine cover. And all the major funds start to focus on the internet. So Kleiner, Sequoia, Benchmark, they completely reposition everything that they're doing. They go raise new funds. Everything is towards the internet. By 1997, they have like 13x the amount of money that they're deploying towards the internet. And so kind of similar to what we're seeing now with AI, where most of the fundraising is going to AI companies. And again, similar, there was a lot of FOMO. There's a lot of casino style speculation. There's, VCs are basically trying to fund companies. They're trying to pick metrics that show traction. So again, this is sort of like the first step towards getting into a bubble type mentality where you're not really focused on profitability. You're not focusing on revenue. You really want to just show what is the best metric for this particular company, shows the most traction. I want to go public as fast as possible. I want to realize these investments. And at the time, not like this is not like today where you have a gigantic, relatively liquid private market. There was no such thing as a private. Like you had to go public, right? So everybody's first step, maybe you race a round or two and then you go public. So get big fast becomes a big deal. This is all about land grab and gold rush. And every sector starts to become webified. And it's all about market share and fast growth, and profitability doesn't really matter. So it wasn't just Netscape feeding this frenzy. So I have some stats here for you. So Benchmark invested $6.7 million for 22% of eBay in 1997. eBay goes public in 98. They make a 60x return in about a year. Sequoia invested $1 million for 25% of Yahoo. They go public in 96, and they're worth this stake, this $1 million is worth $212 million. So over 200x. Kleiner invests $1 million in Amazon in 1995. That's worth $8 million, they invest another $8 million in 1996. That's worth $500 million in 97 when Amazon goes public. So again, gigantic multiples. And all this starts to seep into the mainstream. So this really kind of feeds the hype cycle. So this is the spark.
But what'd you say the revenue multiple was on the Netscape IPO?
33.8 million in 1995. And by the end of the first day, they're trading at close to $3 billion. So 100.
Yeah. So that becomes very common for these kinds of companies to have these. They're not profitable.
Yeah.
And so all you can do is value them on
revenue. Yeah.
revenue. And you have these kind of 100x revenue multiples. Just to put that in context, I was looking at some particular tech companies in the market right now, and they're at like 10-ish, kind of 8 to 10 revenue multiple. That wasn't like that wasn't the Facebooks and Microsofts of the world. They're probably higher. So when you look at the IPO numbers, and this is what can happen with a super long expansion period, right? So when you look at the IPO numbers in 92, 93, 94, you had 400, 500 IPOs a year in each of those years, which is, when you look historically back to the 80s, those are pretty good numbers. These are mostly not technology companies at this point. I think it's about 10 to 15% of these IPOs are technology companies. And then in 95, you have 462 IPOs, so like not that abnormal. But you have this kind of the IPO window is like super duper open as we kind of get to the meat of this expansionary period. But it's not really technology companies dominating it yet. That happens towards the end of the expansion period. The returns, you really start to see the returns pick up from the markets in 95, right? So you had pretty lackluster returns from both the S&P and Nasdaq from 91 through the end of 94. And then 95, you see your first big year. The S&P's up 34% in 94, and the Nasdaq's up 43%. And then you pretty much had amazing years in both through the rest of the expansion period. But you mentioned one of the big changes here was that it was very uncommon to go public without 2 or 3 years of profitability. It's basically unheard of prior to this. So that for a period here, the nature of IPOs changed, right? They became really more about marketing than they did about profitability.
Yeah, and what you mean by that is like companies are going public so they can get exposure. Yeah. This is like part of their marketing strategy is, let me go public, let me get exposure.
And so there was a browser that went public a little before Netscape called Spyglass.
Oh, I didn't see this.
That was like much more. I don't know if it worked. I don't really know anything about it. But it was a much more normal IP. And to me, what I think one of the big differences was that started with Netscape is you had like the real banks starting to underwrite these IPOs with Netscape. I think it was Morgan Stanley. Morgan Stanley underwrote Netscape. And everything I saw before that was banks that either don't exist anymore or are like technology specialist banks that maybe still exist, but I have not heard of. And so that was like the major change, right? You had like the blue chip banks now underwriting these unprofitable companies. That was a big change. Another thing that changed a lot, and actually based on what the history is that Jim Clark changed this, right, is that like, so the VC market as we know it today really came into existence in the 90s. And you talked about how like AUM in the VC market was $1.5 billion, but the ability in terms of like how much that $1.5 billion could have owned of the startups it investing in, there was a dramatic change in the late 80s, early 90s, where prior, like at Silicon Graphics, I think Jim Clark gave away like half or 3/4 of his company to his first investor.
And I don't think we really get in the 90s. We don't really get into kind of like founder control type, what we basically live in today. But it's the first step towards that, right? Like the founders are going to be way more powerful in this period than they ever have been.
Yep. And so and then you start to see deals where they look more like today in terms of ownership per round. The amounts invested and the valuations are lower, but the ownership per round is pretty similar. And so that was a major change as well. So for moving to just kind of capital flows and what was going on Wall Street at this time, one of the huge things you see in this space, and one of the main takeaways for me of this whole study, is you got to watch the capital flows and like what they're saying is going to happen. So just a couple stats here. In 1983, 3/4 of homes own no stock, and 1% of people own 90% of the stocks. And then by 1998, 15 years later, about half the people in the U.S. own stocks, right? So you have this huge swing, and the big change was that the 401k came into existence, right? So the 401k is the general idea that you can invest part of your paycheck into the stock market or bond market, and it can grow tax free. You went from 10 million people had 401ks in '85, not too long after they came into existence, and by 2000, 40 million people had 401ks. During this time, this is probably the most impactful thing I read about this change in capital flows and just like where the money was coming from, was in 1980, the total amount invested in mutual funds was around 49 billion, and then by 2000 it was 7 trillion, and there was more money in mutual funds than there was in the banking system. And so you had this absolutely massive shift in like where the capital was coming from. My take about the IPOs in this stage was that most of the real buyers of because there was a lot of kind of weird things going on with these IPOs, like banks would give them to their preferred clients to trade in and out of in a day, or they'd even stick them in the accounts of executives they wanted the business of, and buy and sell for them in a day. The real drivers of the crazy kind of first day IPO performance and whatnot was really retail, which is really driven by these mutual fund flows. And I think a big part of this, as well as just the availability of the average person to buy stocks, the sort of academic underpinnings that we talked about earlier, where like pretty much everybody believed that buying and holding a diverse portfolio of stocks was a sort of a fail-safe way to do really well. You also had just a complete change in the way the media was covering this space, where you had not only kind of like the first hints of social media around this, right, where you had the first virtual communities of risk takers that could, have access to professional type information and tools for the first time ever. But you also had this media culture of, 24/7 coverage of the stock market from places like CNBC, and that.
Jim Cramer really cuts his teeth around this time. Yeah.
Yeah, I mean, one of the takeaways for me in how to tell if you're in a bubble, right, is if you have like a huge growth of media coming out on the specific area, and a lot of those companies are going public themselves. That was something that happened in a big way during this time period. What did you notice about kind of Wall Street and capital flows?
Yeah, I think it's not just the media. It's sort of the whole system sort of interacts, right? Like it's a self-reinforcing system where you've got equity research analysts that are very involved in the financing and the sort of IPO, dynamics. Then of course you have the bankers, you've got the founders, you've got the VCs. Everybody's sort of incentivized. If you think about sort of like system dynamics, everybody's incentivized to reinforce this loop. The media acts as additional fuel in the fire, or like additional oxygen, really just feeding this and making it massive. And there's really not a whole lot of elements of the system that are feedback loops that sort of check the excess. Like if you sort of look at the landscape, if you look at the puzzle pieces that are interacting, most of them are all pointing in one direction. Like everybody just wants to pump the market. And if you think about now, like, I think especially, we talked about efficient market hypothesis, you would expect that the market, professional investors, maybe even some retail investors, maybe regulators and the Fed, et cetera, you would expect they would be the ones to sort of check the excess and pump the brakes. And that was not happening. I mean, I think, you probably read the 96 speech by Alan Greenspan, where he coins the term irrational exuberance that then becomes like the phrase that defines this period. But it wasn't very strong. We're like, this is a speech that he gave, and it was a closed room that then it gets published, but nobody's paying attention to this stuff. The amount of forces pushing in the direction of pumping the market and like growth at all costs and, super optimism, there is no degree of skepticism almost anywhere, at least not until like 1999. That is the biggest thing that I think about in terms of what was happening on Wall Street.
Well, when it comes to policy and stuff, I mean, one of the main emotions I had as I kind of learned more about this time was just kind of Alan Greenspan was in a tough spot for
Yeah.
a lot of this stuff, right? Because I have a bubble monitor that doesn't go off very often. It was actually going off for the Nasdaq as early as '95, right? So you had kind of intermittently, and then went off on the S&P later on. And so you had this bubble in asset markets.
Can you actually describe that? What was going off in '95 for the bubble monitor? Because I think so. I pulled up the stats, and that's a year where the Nasdaq posted a 40% gain. So I imagine maybe that's part of it. But what is the indicator? Like if you're sitting there on your with your screen. What are you seeing?
I can't tell everybody. That's a secret.
That's a secret. Okay. Well, that's amazing.
I'm just saying I've got a bubble, a thing that signals bubbles and a thing that signals bear markets that's meant to go off very slowly. And you had the Nasdaq signaling a bubble as early as 95, and then the S&P kind of follows along in like 97, starts to signal a bubble. So, but like I said earlier, there's no correlation between the stock market and things like inflation. And so when you look at the numbers, you had unemployment kind of started this time period at unemployment started this part of the cycle closer to 8%, and then it went all the way down, just like a ski slope, down to 4%. Meanwhile, inflation is not really doing a whole lot. Like when you look at this time period compared to other cycles, like so the average inflation in a expansion period is actually 3.7% back to World War II. But in this case, inflation actually averaged 2.6% throughout this whole expansionary period. And so, you're sitting there, you're in your Alan Greenspan, you're kind of like, well, like I care about, they have a dual mandate, right? And they had it back then, which is inflation and unemployment. And so, based on these indicators, like it's not the Fed's job to pop a stock market bubble unless it starts to affect the real economy. Yeah. And so to your point about like nobody's negative, I think one of the ways to tell also if you're in a bubble is if there was no benefit to being negative for like 5 straight years. Like you can look anywhere you want. Maybe the sort of couple month period of long-term capital management, there would have been a benefit to being negative, but everybody that was negative during this period got fired.
Yeah. Well, I mean, I think that's a good point because if you look back, there's a great book that I was telling you about called Capital Account. And this is the guys from London Marathon Asset Management. And it's a book that basically uses their writings from the 90s. And one of the things that's pretty consistent that they talk about in there as far back as 96 is that they thought the market was overvalued. And if you're using sort of the capital cycle framework to look at this, maybe we'll talk a little bit about telecom capex, but they were already seeing that returns were probably going to be suppressed and that there may be a bubble forming as far back as 96. And they talk a little bit about how it's really tough, like from an asset management, like an institutional investor that has to compete against the benchmarks. It's really tough for you not to play the game, which I think is probably the flip side of the argument I was making, which is nobody's checking this. Well, of course, nobody's checking this because a critical part of like structurally how the system works is that if you are paying attention to the markets and you know how to bubble, you have a bubble indicator, but you've got LPs that are kind of knocking on your door saying, hey, the market is returning like the Nasdaq in 95 was like 40%. And you underperformed that because you thought that there's a bubble going on and you were pulling back. Maybe you put something in bonds or gold or whatever, then you're going to lose AUM. And that's like the whole core of your business. And so there's also like structural components of the whole system that maybe amplify some of these things.
And so like put yourself in the shoes of like someone that was like famously negative throughout the period was Barton Biggs, who was one of the big asset managers. And he's talking about valuations and free cash flow, discounting free cash flow and kind of all the traditional things that you would use to value a company or to value an index. What do you think the one thing that like, was there anything that anybody thought about that period that you thought was like, okay, that's like a legit response to like basically historical valuation paradigms are irrelevant now? Like, was there anything that you're like, okay, like pets.com's not doing it for me, but but this thing that Alan Greenspan said in this speech, I was kind of like, okay, like if people thought that, then maybe there was some.
I don't know from a policy perspective, but you look at some of like you read the Amazon shareholder letters from this time period, and you look at the stats that they were posting, and you get a sense that there's something different about Amazon that I would like to think that a good investor should be able to recognize. Now, despite the fact that if you had invested in Amazon during this period, and of course if you held it all the way through to now, like you would have made a killing, but at this time, like Amazon's going to draw down like 80% when the bubble bursts, right? So even though like you could have recognized that this was a good investment even back then, you're still going to experience a massive drawdown that if you could have avoided, you would have been much better off. Did you see anything policy-wise specifically that jumped out at you?
Listen, I guess I'm less asking about policy, and I'm just used Alan Greenspan as an example. I was just trying to like, if you came across anything that you're like, oh, okay, the reason people acted this way is that they thought this, and I actually might have agreed with that at the time. The thing that the thing that kept coming up over and over again in different ways was that not only were we having this experience with economic data that was just challenging what people thought about how the economy worked, right?
Yeah,
The idea
this
that
time is different.
yeah, the idea that inflation could be this low and unemployment be this low and growth be this high, and you start to see the productivity numbers tick up for the first time in a long time. That's interesting. But the thing kept coming over and over again was that the internet enables just much better decision making, right? Like, and if you're Barton Biggs and you're pushing back on how people are valuing internet stocks, and then people say, well, like people are making 10 times better decisions than they used to be able to make because they have real time information about inventories, and they can more quickly and more clearly see what customers want. And so like how should like the comment of like how should a valuation paradigm change when all of a sudden your uncertainty levels are reduced by a huge amount, right? Was like what I think people thought was happening.
Yeah.
And that's the only thing that I like. If you believed that, I don't know that there was like enough evidence of that.
I guess it's easy to get caught up in the psychology of thinking this time is different and get enamored with the technology and what the future might look like. But I think you always have to come back to like what is real now. And I think that would have been the one thing that I would hope, like from a clear thinking perspective, that would have grounded you to, well, what is real and what is either hype or future that is still pretty uncertain. Like the distribution of outcomes to paint that picture of like everything is more efficient and less uncertain. You have to buy into this is coming. This is going to have an impact in the future. Like, this is an input. There's going to be an output in the future that's going to make these companies really valuable, and I have to buy, but I have to pay for it now. And I think that's probably where people get into trouble. And that's definitely what happened for most of the dot-com bubble, at least in my opinion. At this point, again, let's get deeper into it.
Yeah. And just a little bit more market context. I think one relevant thing as you think about bubbles and technology, because it is often, the technology sector that causes these bubbles, but just market concentration, right? Like what percentage of the S&P 500 is technology companies at this point, right? Or kind of 95, 96. And so the S&P is, sub 10% tech in 90. It's actually it's about the same or more telecom. I think telecom went a little nuts towards the very end of this, actually due to a new law that we'll talk about. But telecom, I mean, these are hard asset businesses, right? These aren't websites, so they're a little different in that sense. But it really wasn't until 98 that you start to see technology become a major part of the S&P 500. Obviously, it was a much bigger part of the Nasdaq, but the Nasdaq, is not something that not something that you probably have in at least today. People aren't owning the Nasdaq in their retirement accounts as much as they are the S&P 500 and the Russell 2000 and things like that. So I think that's like a relevant thing to keep in mind. By 99, we start to get, I think in 1 month in 99, tech and telecom were over 40% of the S&P 500, and it was mostly tech, which was like 35% tech, which is, and this is one of the things people use to compare this period to now, right? Because tech is a huge part of the S&P 500 now, but again, these are like totally different kinds of companies than they were then. So that's just some important backdrop. And then in 96, just as a marker, you have the biggest IPO ever from Lucent, where they raised $3 billion. And so you're really starting to see this kind of get going in the 95, 96, 97 time period.
And remind me that is a telecom company, right?
Yeah.
Yeah.
I think they were an equipment maker. Yeah. And I read somewhere that they were the most broadly owned stock in the world during this time period.
The one stat, and again, I guess we're not going to get too deep into the telecom world, but the one thing that I read that I thought was pretty fascinating, because this always happens during this period. So there was one quote that everybody was quoting in the telecom world, which was data traffic is doubling every 90 days. Did you come across this? And that was used to basically justify the amount of telecom investment that's going to come over the next kind of 5 years, starting in like 96. And of course, that ended up being wrong. There was a report that was cited that was backing this up, and that report was not right, but it was perpetuated, and the whole market started using this quote of like doubling every 90 days. So of course, they're going to build a tremendous amount of capacity that doesn't really get fully utilized for like another 15, 20 years.
Yeah, so one interesting thing that I read on that, right on just the telecom build out, Which, I mean, my read is that really started in 98, which started to allow haul communications companies to compete with short haul, kind of last mile companies. They could both compete with each other. So that created this like frenzy competitive, again, free markets, right? Just kind of behind everything that's happening right now. You can see the big effect of the 96 Telecom Act, because in 97, 98, 99, you have an enormous amount, or much more than historical debt issuance from the telecom space, because again, these are hard assets, so great for the debt markets. And then you can also see, I think I looked at like just capex during this time period, like the capex associated with tech and telecom like was 30% of total capex spent, when it's normally like kind of 10-ish%.
Yeah.
So you just had this massive build out of these fiber lines.
So one thing that is interesting on the telecom piece, just the capex numbers, 'cause I think there's a parallel to today. I think that the world is very different, and the way that this is being invested and deployed is different. In 97, there was $50 billion worth of capex being deployed into the telecom space. By 99, that's 82 billion dollars, and by 2000, it's 113 billion dollars. So there's this massive surge based on expectations of demand that, kind of spoiler alert, doesn't materialize for a really long time. And so a lot of these companies end up losing their shirt and going bankrupt as a result. But there's just a massive growth in the capex on, putting all these hard assets on the ground. Where do we go from here? So do you want to talk about, I think long-term capital management is an interesting one, maybe because there was a bit of a perception that we had sort of solved the market.
Yeah. So this is kind of like we mentioned earlier, that there was a major kind of academic backdrop to this, where my guess is, like, along with VCs and founders and investment bankers, it seems like we were in a period where like the academia was more on a pedestal than maybe they are now, especially at least in the investment kind of arena.
Yeah, we didn't have the skepticism on experts that we have today.
I think I know what caused that. It's called the internet. And so the peak of this sort of the belief in academia and what they had kind of supposedly proved, that investing was a science, and you could kind of put it in a box and make it do what you wanted it to do. Kind of investing more as chemistry than as painting, was long-term capital management, where you had some of the kind of most famous people of the time all come into one company, mainly Robert Merton, who is best known for essentially inventing Black-Scholes, which is the equation you use to value an option, and John Merriweather, who came out of Salomon Brothers and was just an arbitrager, right? This time period is all about finding spreads that are out of line, and levering up a ton and buying the spread until it comes back in line, basically.
And Myron Scholes, the other part of Black-Scholes, is also a long-term capital management.
And so this fund, it was a $4.5 billion fund, but it was about 30 times levered, and so it was well over 100 billion, including leverage. And then when you think about, probably due to digitization, at least this came up in a bunch of speeches, was that the growth of the use of and growth of derivatives markets during this time period was kind of hailed as a major advancement, right? The ability to break up the components of risk for anything and put those in the right hands, where where the person knew the exact risk they were taking, and really spread the risk around, was hailed as like this massive innovation in finance.
It's like they solved risk. I feel like that is the sort of, and that's going to fuel not just this, right? But at some point we'll do the GFC and talk about the housing bubble, and there's a huge component of perception of solved risk that ends up fueling that.
And so there was this view that investing was like the markets were kind of this continuous normal distribution, where you could always count on the probabilities of a normal distribution, and you wouldn't get these outcomes of like dislocation, right? Where like the stock set at because they were really focused on how near historical volatility that honestly didn't go back that far. I think they were only looking at volatility like back a couple years, and the thinking that volatility was going to continue at all times and forever into the future was kind of the underpinnings of a lot of these trades they had on. And the idea that the idea that investing really has fat tails, right? Where you have something that looks normally distributed, but you do get these like massive dislocations more often than you get in a normal distribution. Based on what I read, it was almost like they knew that, but they were just using the best models they had at the time. Like that's something I read. I think that was like a quote from one of the people that worked there. Like, the models we were using were the best thing that we had at the time.
Well, I think they thought that they had solved, like they thought that they had enough precision to be able to understand and kind of predict those events,
Right.
more than like truly believing that it was normally distributed. I think they knew. I mean, like these are the best guys in the world at sort of modeling this stuff. They just thought they had solved it.
And so they were doing things like yield curve trades and buying buying like the less liquid securities relative to the more liquid securities that would trade at a discount just because they were less liquid. And then especially in the debt markets, at the end of the day, liquidity doesn't matter as long as the company doesn't go out of business. You get par back kind of trades. They were doing them in like massive size, right? And so when volatility hit, which in the back half of the 90s, you had a lot of volatility caused by currency crises around the world. I think starting with Mexico was the first one, and then you had, was it Indonesia or Malaysia? And the big one was Russia. But I don't think, based on what I read, like I guess I thought coming into this that long-term capital management like owned Russian bonds or something, but that wasn't it. Like it was just that all of this international currency volatility caused the markets to act in a way that their models didn't have in them.
Yeah.
Right.
So they got blown up.
Right. And so and then it wouldn't have been nearly that bad if they weren't so levered. They were super levered. And then they also had, they were super levered and they were putting no margin up at the banks they were trading with.
And they were linked. I mean, their counterparty risk was massive, right? Like it was very systemic, which is what triggers crisis as a result of this. Like they basically have to get bailed out.
Right. And people tend to, I'm curious what you think about this, but people tend to reference this period as the first example of like the government bailing out Wall Street.
Right. Even though it was kind of a private bailout, but it was a forced private bailout.
Was it forced?
Yeah, I mean, I think the Fed sort of organized and talked to everybody, but ultimately it became more of like an old school, like JP Morgan style bailout.
Right. Because it wasn't government money.
Right. It wasn't government money. That's right.
I think the issue, I mean, markets, my take is that markets they're actually okay with bad news. If I put myself in I think it was a very JP Morgan, kind of pre-Fed type experience where my understanding is all the bankers were in a room at the New York Fed and they all committed to what they were going to put up to buy long-term capital management. And the thing that was driving them was uncertainty, not bad news, right? Because the uncertainty you had is that you had a company of a notional amount of $1 trillion that was all intertwined with these banks. And and one thing they did, right, is they were very secretive. So they never traded both sides of a spread trade with the same bank. And so it's like you've got this $1 trillion thing that has trades all across all the banks with no margin. And so it's really the uncertainty of the situation that drives, all the big banks to eventually buy long-term capital management. And in terms of the impact to the markets from that, two things to mention. Again, this is kind of nerdy, but I just think it's interesting. Like to me, the correct lens to think about markets is through this concept of market cycles, right? Like a bear market, a recovery, expansion. And so like when a bear market happens is like a huge part of studying the history of markets. It turns out that there was an intraday bear market from this long-term capital management issue. But by the way, one thing I read is that at the time, because I'm sure nobody understood or knew what long-term capital management was, but apparently at the time, a lot of people thought the market was tanking because of the Clinton-Lewinsky scandal.
Yeah, I didn't read a lot about Bill Clinton in my research. That's funny.
And so the market, I think it closes that day, not in a bear market. I think it was like 19.5% down, right? It's interesting how the markets do that. Like they wouldn't let it go. And apparently the market didn't think this should start a new cycle and be a bear market. But then, you have Bill Clinton. I think the quote was saying, this is the most challenging financial environment we've been in 50 years, I think is a quote.
In 1998.
From this exact issue. Meanwhile, I think there's still, let's look at the IPOs from 98.
Yeah, this is not at all going to temper anybody's animal spirits.
Yeah, so you have less IPOs in 98 at 283. My guess is most of those were technology companies. But so in response, so the Fed had kept rates pretty much the same since the Netscape IPO.
So they were at 5.5% in '98, and they lower rates as a result of this. Right? Like I think they do three rate cuts.
Yeah, so rates are in the mid fives, which that may sound like normal or high or whatever today, but that was actually, when you look at the Fed funds rate, back historically, it's very, very, very low and very stable. Fed funds rate and just debt market in general. And yeah, so Greenspan comes in and he actually cuts 3 times in '98. And if you put yourself in his shoes, right, like the markets are down a ton, you've got this super huge uncertainty around this $1 trillion of notional value. And there's also these other things hanging around, like, Y2K is approaching. Do you remember where you were for Y2K?
Yeah, I was in Venezuela for sure.
Right, we had gone skiing that day, and we were all in a hotel. Like, I think
in New Year's '99.
Yeah, on like a 2-bedroom hotel, and we all stayed up until the ball dropped to be like, what is going to happen? I don't think any of us understood why it was a problem.
Yeah.
But anyway,
Nothing blew up. Nothing happened.
One thing I didn't read about at all that I assume was on people's minds was this is like when the euro was coming together, right? So like that had to have created some uncertainty, right? That's like an experiment in combining all these currencies together. So anyway, you actually have a period right in the middle of this kind of market madness where the Fed is actually cutting rates, not 25 or 50 basis points, but actually 75 basis points. And I guess the announcement that this would be something I'd love to ask somebody that was there, but I guess I'm assuming the announcement that these banks were buying long-term capital management was all fine.
Yeah.
And so that all, I think that almost bear market was in like the September-ish. Yeah. And then from there you just have like absolute liftoff. So anything you'd add to the long-term capital management stuff?
It's funny because you read stuff about long-term capital management and it was such a big deal. Like in hindsight, it was a gigantic thing to have happened. And then you look at the market data and it doesn't really show up, right? Like it's a bit of a blip and it doesn't really do anything in terms of the giant, bubble. But maybe there's a bit of moral hazard. Like I think there's a sense maybe in the investment community, at least in some pockets, that nothing bad can happen already. And then this happens and maybe people are watching and then things just are fine. And so you're going to see an inflection point, right? Like, because markets really rally after this, like entering 1999, the market is going to go hyperbolic.
Yeah. And I mean, when you look at the data, it's not unfounded, right? I mean, so one thing to mention before we kind of jump into some of the data of this particular part of the expansion period is just something we've kind of danced around it, but just the faith in Alan Greenspan. During this time. And so like this is now like the second, or arguably the third, if you include 87 Gulf War and now long-term capital management. This is the third thing that like almost brings the global economy down, is probably what people felt like at the time and may have been true, that Alan Greenspan kind of successfully navigates. And so when you get into just to get into the stats, right? So we talked about how during this expansion period, real GDP grew at 3.4% and inflation was 2.6%. So you had real GDP growth of 0.8% in this expansion period, which is actually pretty normal for an expansion. But it's super long. In the post-95 period, right, so post-Netscape, GDP grew at 4.5% on average. And in the years we're talking about now, you started to get growth numbers of above 6%, right, real. Yeah. So and inflation's still below 3%.
Which, can you imagine if we were growing at 6% right now?
It's like emerging market growth.
That is massive.
So when people talk about this time period as like a new economy, this is what they meant, right? Yeah. The fact that we're growing at 6% real, and inflation is not too far from the Fed's target is what people mean when they say new economy. And so the markets go into this absolute liftoff phase. And by the way, the other thing happening during this period is now you're starting to get like real productivity numbers. Like people are starting to be like, okay,
yeah, the productivity print is going up into the 2s at this point.
And so people are thinking, we're back, baby. Because one of the things I thought was really interesting was in the period of low productivity from the 70s to the early 90s, or really mid 90s, we actually had lower productivity than like other Western countries by like a noticeable amount, right? Yeah. Like Canada and a lot of countries in Europe. And so this is like a major boost to everything that you're seeing, high growth, high productivity, low inflation, low unemployment, consumer confidence hits an all-time high in the late 90s. And when I say all time, I mean even up to today, actually, like noticeably higher than anything since then. The savings rate for consumers went very low. And some people, I didn't see this in the data, but some people say it had gone negative, which is like that's also like an unheard of thing prior to this time period. And the reason that was able to go negative, right, is people were making so much money in the stock market. That was making up for that. They were saving in the stock market because they were now, 10 times wealthier than they used to be. And so when you look at it from an IPO perspective, which to me is like the kind of main thing. So in 97, 98, 98, 474 IPOs, 283 IPOs, and 476 IPOs, which that's not like that abnormal for this cycle more broadly. But I think the thing that really makes it stand out is that specifically in 99, you had, I think, 76% of the IPOs were technology companies. A very high percentage of these IPOs were technology companies. And when you look at the IPO history, even though the number of IPOs was very tech heavy, the total number wasn't necessarily something that like was as eye popping as maybe you would have thought it would be. But the size of the IPOs was much different than it had been historically, right? Like the percentage of IPOs that are generating over 50 million of proceeds for the companies is like 10 times more than it had been in the past. And so that's kind of what stood out to me about as we kind of head into this boom period.
So there's a bit of a deal frenzy, and this is I think where Netscape, the sort of the full cycle of Netscape comes to fruition because AOL is going to acquire Netscape. And then there's the merger with Time Warner that comes later. And what did you think about the development now? Because there's a lot of companies, like the whole market has realized that you have to be a technology company. You want to transform yourself. You want to get the stock price valuation. There's a lot of like this concept of shareholder value, and there's all these like incentives for executives to pump the stock price. And so everybody's trying to become the thing that the market wants so that your stock price goes up. And so, of course, Enron is like a poster child for this.
To me, the thing that I think stood out the most when you think about like what was really crazy about this time period, right? Because like some of the stuff is, you would expect a super strong market in this time period, but like if you look at the mean first day returns from IPOs during this time period, in kind of 95 to 97, you're like kind of you're 15 to 20% first day returns. But then in 99, you get 71% average first day returns from IPOs. And like just in general, like how are the markets doing during this time period? So from 95 to 99, you actually have like just really pretty consistent gains from the S&P, right? So 95, 99, 37%, 23%, 33%, 28%, 21%. And then you have your first down year in 2000. But then the Nasdaq's a different story, right? Now you're up from 95 to 2000, 43%, 43%, 21%, 86% in 98, right? The year that long-term capital management happened.
Yep.
Then 102% in 1999. And you have some of these IPOs are just hard to imagine, right? Like, so I wrote a couple down here, but like Line IPO'd in March of 99 at 10 billion, which was more than like most of the legacy airlines combined, and eventually traded up to be worth more than the entire airline industry. Yeah. And this is just a place where you book tickets. At one point, there were more mutual funds than listed stocks on the New York Stock Exchange and Nasdaq. And you had some of these IPOs are just insane on kind of first day gains. Like the big ones were like the Globe IPO and VA Linux kind of had similar outcomes to Priceline.
Which was how much? Like how much did they pop?
Over 100%. Yeah. So to me, one of the best ways to gauge something like this would be spreads between different asset classes, right? Especially the equity risk premium, right? Like how much are investors being compensated for taking the risk of buying equities versus just buying something not risky at all, like money market funds or the 10-year treasury or whatever. And so in this case, for the data that I'm looking at, which is back to the late 50s, the equity risk premium got down to 2% in 99. And the average is 4.25% kind of over this time period. So, but when you look at it, in the late 70s, early 80s, arguably where this time period of, declining rates, low volatility, relative to history started, you actually had equity risk premiums of 600 basis points, 500 or 600 basis points. So like, and then just kind of a pretty smooth ride down from 1980 to 1998 to all the way to 2%. And then when you look at credit spreads, like spreads between different types of debt, these spreads actually were increasing throughout the end of this cycle.
Yeah, so basically what you're saying is that the equity markets were the ones that were pretty exuberant and there was less interest in credit. Like you weren't seeing crazy risk taking on the credit markets.
Yeah, it doesn't seem like it. And a lot of there wasn't a lot of the tech companies were. That would have been crazy, right? If you had these websites issuing a ton of debt.
Right. Well, my guess is that it's just a capital flows thing, right? Like just the capital is flowing to equities, which is flowing out of credit probably, and it's driving spreads wider. That's my guess. There's just less demand for credit.
Yeah. And so at the end of the expansion period here, at the end of this kind of euphoric couple of years, you had 109 months of expansion where the S&P, right, not the Nasdaq, which would have been much higher. The S&P in aggregate was up 314%. On an annual basis, it was up 17%, which is actually smack dab in the middle. That's what the average is for equity S&P returns in an expansion. So it's just really long compared to other ones. And it really 99 was the really big 98, 90 because the S&P was pretty consistent throughout the whole period, starting in 95 at least. But the S&P returns were really big in 98 and 99.
And we should say too, like I think if you pulled up a chart of the Nasdaq and the S&P, the market really goes hyperbolic in the Nasdaq. Like this is really a .com tech company boom. So I guess one more quick anecdote on like the euphoric period before we sort of move to the crash. Did you read Dow 36,000? Did you see Dow 30? So
I saw it mentioned.
Okay, which is an index we haven't really mentioned, right? But there was a book called Dow 36,000, which basically was the epitome of this rational exuberance, which was saying that we were headed to Dow 36,000. And to put that into perspective, we were closer to like, I can't remember the exact number, but we were like at 8,000. The Dow levels were like 8,000 was the index level. We don't actually get to 36,000 until 2021. And we touched 36,000. We don't actually sustain levels about 36,000 until 2024. And do you know who wrote the book? Like one of the co-authors, Kevin Hassett, who is now, of course, the director of the National Economic Council. So cast of characters that are still around. But yeah, pretty fascinating, right? Like they were basically predicting that the Dow was going to quadruple, and that was the tone in 1999.
We talked about how even in the beginning being in the Netscape time, which isn't the beginning of the expansion, but the beginning of kind of when this tech bubble started. You had tech companies IPOing at 100x revenue multiples, and that was fairly common throughout the whole.
They had no earnings, right? Like there was no concept of PE valuation for any of these people.
Right, and so I think if I understood correctly, the thing that started impacting, like I think AOL went into the S&P 500 in like 97 or 98, and that's kind of when you had a bunch of. I mean, Microsoft was one of the biggest companies in the index throughout the whole period, but again, they're like a real business with real free cash flow and things like that. Yeah. The chart I'm looking at has the S&P multiples peaking in the 25x range. I think that is wrong. I think I read that they really peaked in like, I think it was like 32.7x was the S&P PE multiple peak, and that was pretty much the exact same peak as before the 1987 downturn. So you had very very high valuations, but you had them again for so long that people were losing their jobs by saying, by pointing at valuation as a reason that the markets could correct.
Yeah. I just pulled it up. So we got to 46, but that didn't actually happen until November 2001.
What was
the
the
telecom companies?
What was it in like 99?
So in 99, the S&P is at 29. It peaked at 33. It starts coming down, and then it goes back up. In fact, we were already in recession when it started taking back up. I think it's into like 46, which kind of makes sense because earnings are coming down.
And so you did have very high tech concentration, very high valuations relative to history. I think the average PE ratio is like closer to 15, right? I think an average PE ratio of the S&P and Nasdaq since February 1990. So actually, this is supportive of that, but it's 16.5x with a standard deviation of 3.3x. And so you're in the 30s. You're starting to get however many standard, like 4 or 5 standard deviations away from average.
Yeah,
and that's another thing people quote a lot today. And so, what do you think caused the downturn? So, like the peak
You ready for the pop?
Yeah.
Actually, I want to add one more story. There's a famous Warren Buffett article from November 22nd, 1999, published in Fortune magazine. Basically, it's an article actually that's a compilation because Warren was going around in 1999, starting in like July. And it's one of the few times in Warren's history where he actually commented on price levels in the stock market. Most of the article, so he doesn't specifically come out and say, the market is overvalued or there's a bubble, but most of the article constructs returns. And he frames it as a function of two variables, interest rates and corporate profits. And what he does is he tells a story. If you look at interest rates, and again, this is 99, if you look at where interest rates are and you factor in inflation, you get to a real interest rate. And then you look at what the expected returns are from the market. And you look at corporate profit history, which at the time, and this has changed pretty dramatically over the last 10, 15 years as the economy kind of has financialized and tech companies dominate. At the time, the range of after-tax corporate profits historically was basically 5 to 7%. And so he builds the case that if you look at where price levels are today, or 1999, the market seems to be overvalued. Is sort of the implicit thing. Again, he doesn't say that, but there's a great quote which I think is interesting for us to think about. And he says, perhaps you're an optimist who believes that though investors as a whole will slog along, you yourself will be a winner. That thought might be particularly seductive in these early days of the information revolution, which I wholeheartedly believe in. Just pick the obvious winners, your broker will tell you, and ride the wave, right? And so he's kind of setting it up. And then he says, the key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and the durability of that advantage. So November 1999, he's basically telling us he thinks the market is overvalued. And as we know, the Oracle of Omaha is almost never wrong. So a couple of things start to happen. So first, the Fed start to raise rates in June 99. So they basically, they go through a bunch of quarter point increases. Before it's all said and done, they're going to raise rates to 6.5%. Rates enter this period of like 4.75%. They go all the way up to 6.5%. The economy's running too hot. Greenspan says it's pretty clear they're going to try to cool this boom. Unemployment is still low, growth is strong, so they feel like, okay, this is the time to do it, right? Dual mandate is being fulfilled, might as well raise interest rates now before things get out of hand. The markets don't respond to this immediately. So you see rates are kind of going up. The market is still going up. The Nasdaq didn't actually peak until March of 2000. So again, markets are not responding to the rates, but that is one thing that starts building towards a bit of capitulation, like a bit of sobering up. Fed funds rate has reached 6%. They tightened the screws. The last raise is 50 basis points, which they do in May. But by that point, the bubble's already started to pop. So to your question, what's going on? So March 13th, first big inflection point. Japan enters recession. So everybody's paying attention to this. It's a big deal. Triggers a bit of a sell-off, but it's not massive. So the Nasdaq only loses 2.5%. Around this time, the other major factor is that a lot of these dot-com companies are running out of cash. So again, profitability was not the thing. Cash flow is not the thing. They're all trying to go for the land grab. So they're running out of cash. They need to raise money again. And there's just not that much money left. Like they've already gone public. Capital flowed into the market. And there's a bit of skepticism building. Then on March 20th, two things happen. There's sort of two conflated things. One, Barron's publishes this article. And the title of the article is Burning Up, Warning, Internet Companies Are Running Out of Cash Fast. And they make the case that a lot of these companies will probably fail by the end of the year. Basically saying, look, if you look at their balance sheets, they don't have cash. Markets are kind of starting to close. There's not a lot of people left from them, for them to raise money from. They're going to run out of cash. The second thing that happens on March 20th is that MicroStrategy of Bitcoin, fame now, at the time they're just a software company, they announced that they're going to be restating 2 years worth of financials. And, we haven't really gotten into all the financial scandals that are going to happen here over the next couple of years into like 2001, 2002. But this is sort of the beginning of the aggressive accounting age coming to an end. And so they had to restate 2 years worth of financials. They had booked a bunch of revenue that they shouldn't have booked, even like contracts that hadn't even been signed yet. And so that's again on March 20th. The vibes start to shift. So by the end of March, you have recession fears. If you look at the yield curve is already starting to flatten. And so you kind of have a sense that maybe there's a recession coming. And people are raising questions about cash runway. And so arguably things have already started to turn, but it's not quite obvious yet. Then a bombshell. On April 3rd, a judge rules against Microsoft. So at this time, Microsoft has already been fighting an antitrust case against them. And on April 3rd of 2000, the judge rules against them. Basically says, you are a monopoly. We're gonna need to remedy this. We may have to break up the company. So with that, the Nasdaq falls 8%, and by the end of that week, by the end of the second week of April, the Nasdaq's going to be down 25% week over week. It's just massive drawdown. Again, the S&P is not reacting quite as as intensely, but the Nasdaq is sort of like on notice. Like, this is the beginning of the crash. That sets the stage for some more skepticism. The lights are coming on, but there are still some animal spirits out there, people buying the dip, and the market bounces back. So it doesn't come all the way back, but there's a ton of volatility from this point. So from April through about August, the Nasdaq is going to be massively volatile. In fact, that at this point, I think on the year, like year to date, the Nasdaq is still gonna be like 8% up. So we reached peaks in like February and March, and then big declines, but year to date, the Nasdaq is still up 8%. Spoiler alert, this is it. Like, this is as high as it's going to be for a long time. Like, the Nasdaq is not going to get back to these levels till like 2014, 2015. In September, the economy starts slowing down. Commodity prices are going up. Companies start warning that they're going to miss their earnings targets. And maybe the cherry on top, and maybe this is hindsight bias, sort of, Apple is not back then the company that it becomes today, but they miss their earnings at the end of the month. Their stock declines by 50% in a single day. So prices take a bit of a breather in October, but they start to slide again in November. Arguably at this point, everybody's running for the exits already. I think entering 2000, everybody was already kind of skeptical and weary of the price levels. But by November, it's pretty clear that even the most optimistic retail investor that was buying the dip this is not going to end well. So there's no price support at all at this point. Economic indicators are flashing red. Companies start to run out of cash. Pets.com lost $147 million in the first 9 months of the year, and they filed for bankruptcy on November 9th. Webvan had invested like $1 billion building infrastructure. Suffice it to say that they're not generating enough revenue. They can't raise any more money. They're also going to go away. It's starting to become pretty clear that there's not enough demand for these companies. Like, these companies are out there. They had a vision. I think they sold their vision. People believed the vision, but the demand was never there. And it's definitely not coming fast enough. And maybe not yet, at least, right? Because we can get into, when in the aftermath, what was hype and what wasn't. But now people are running for the exits. By the end of the year, the Nasdaq is down 40%. .com companies are down 80%. Amazon famously is down 80% by the end of 2000. And Microsoft itself is down 62%. Even companies like Intel and Oracle, they're down like 20, 30%. So bad year.
Yeah, I think it is interesting because it's I think a lot of people attribute this downturn to 9/11, which didn't happen until a year and a half after the market corrected, and the market and the S&P was in a bear market by the time 9/11 happened. And so it is interesting to talk about like what caused this.
Yeah. And it's a blip, right? Like 9/11 is just a blip if you look at the market charts. There's a lot of stuff that we can talk about how 9/11 changed everything, but it not from a market's perspective.
Well, I think the S&P was down about 20% peak to trough when 9/11 happened, and it ended up down 49% peak to trough. So it went down more after 9/11 than before. And again, you had a much longer than average bear market. I assumed that was caught, that the reason that it was longer and deeper was because 9/11 happened in the beginning, right? Yeah. When you look at what causes bear markets to happen, it's really three things, right? It's interest rates, it's shocks, and it's military stuff. Look, I think there's a saying. There's some saying with military where it's like, sell the news and buy the tanks, basically, like, right? Like when there's uncertainty about the military, the market tanks. But once the war actually starts, and you can start to be like, okay, we're in a war. Wars typically take this long and cost this much. The market can start to price in. Again, that's the bad news versus uncertainty thing. And so when I look at it, like,
well, but to your point, going back to that point on 9/11, like if you look at the markets, like the markets close, right? Like they're closed for several days, and then they finally open. There's a big drawdown, but then they come right back, kind of like right at the same level, and they don't really start to tank until you see Enron scandal, financial shenanigans, and WorldCom bankruptcy. It feels like there's a whole lot of really bad stuff that happens where everybody's punch is getting taken away, well beyond that.
And one thing I read that was interesting and maybe indicative was AOL had a pretty big accounting scandal in '96. And you read it, and the way that I read it was kind of like, it was almost like favorable to the tech companies because, I mean, what it was is they were capitalizing their marketing expenses, But the way the book I read wrote it almost made it seem like, this was all so new that like people weren't sure what was what in terms of like how to account for it, which is kind of interesting to think about. And so the only thing I would add to what you said was when it comes to the Fed, right? So the Fed lowered rates 75 basis points in the back half of 98. And then it started hiking again in mid 99.
June 99.
And when I look at it, I think one thing that's important is my understanding is the way the market received those hikes was until rates were back up where they were before long-term capital management, then it was just kind of like getting back to normal, right? Like there's really only once rates went above where they were for long-term capital management that the market like cared at all, because they were like, this is just a normalization.
But this is one of the things that I would love to ask somebody who was active in the investment community at this time, which is, what was the narrative at the time? Like, how much were people paying attention to these rate hikes? Because the correlation is not super strong with any of these rate hikes.
When the numbers I'm looking at here show us going from 5.75, which is, or let's say 5.5 in early 2000, which is where we were before long-term capital management. So that's the normalization period. And then they're at 6.25 by May of 2000.
Yeah,
right?
They do two more hikes. They hike in March, and then they hike again in May.
Yeah, and my understanding is that that's when the market turned down, right, in that time period.
Yeah.
And so in this case, I think there's an argument that the initial downturn was, my read of it was that it was, these are all kind of the same thing, but it was caused by rates going up higher than they were for long-term capital management, the Fed signaling that rates were going to continue to go up. It's an interesting thing to talk about, like why they were doing that, right? Like, because it's not,
Well, and they don't actually do that, right? Like they flatten here, and they're not going back up to this level until now.
Yeah, right. That's true.
And this is the fastest. Like once they actually start cutting rates, this is the fastest rate cut in history, of this magnitude. Even through the Great Financial Crisis.
The only thing because you read about why did they raise rates above long-term capital management time period, right? Because in 99, once rates have normalized, just to make it clear, you're sitting at the same interest rate levels as when Netscape went public, right? And you see a lot of the commentary in the Fed speeches at the time is all about the wealth effect, right? Like how people are feeling so wealthy that it's starting, like the stock market. I think the saying is that for every like dollar of stock market increase, people spend 3 cents of it is like the heuristic. And so, but you're not seeing it in the data, right? So I didn't see anything. The only thing I saw that was like, that you kind of nod your head at as like, okay, that's a sign that, things might start to overheat, was oil prices were up.
Yeah.
Right. Like, so when you look at oil prices, they in 96, they were at $24 a barrel. It's kind of funny. And then they went down to $12 a barrel in 98. And then they rose up. By the time the market corrected, they were at $32 a barrel, which doesn't sound that high today. But like when you look at the history, that's higher than they've been on a sustained basis since like the Iranian oil crisis.
But there's all these conflating variables, right? Like you're hiking rates above the norm, the sort of pre-long-term capital management period. You've got the Microsoft stuff. You've got companies running out of cash. You've got all this financial stuff that's coming out, these restatements of earnings and things. And so it feels like if you look at all these downturns, it's never one thing. It's never like one thing that triggers. It's usually multiple variables. And then that causes people to rethink, what are we doing here? Like, did something like fundamentally change? And as soon as you get a handful of people that start running for the exits and maybe some price movement, then everybody else starts to follow. And then fear kicks in.
Right. Yeah. And there was definitely a spiral with the media. Like they're all just a plethora of articles. Like I read the Amazon.bomb article, which is in Barron's, right? Which is, I think it was on the cover of Barron's, which, Barron's that's not like a normal Barron's move.
It's also, I guess, if you're running one of these magazines, you've spent the last 5 years pumping positive stories about .com. I assume that there's also a bit of differentiation going on. Like the next positive thing or like hypey thing is not going to get engagement. It's just the same thing that everybody has been saying. This is boring. Now we got to be negative. You see like those cycles going on in media all the time. So the wheels are coming off. 2001 starts off more sliding, real fears of recession, and that materializes in March. So the U.S. officially entered a recession in March. Now, that's going to, in hindsight, be the beginning of the recession. It was relatively mild. This recession is only going to last 8 months. GDP is only going to dip about like a third of 1%. So again, one of the mildest recessions on record. But to your point earlier, it came after the longest economic expansion in U.S. history, right? So I think maybe people are not ready for this. Employment, which had been at 4%, is going to rise and hit
about 5.5%. And again, not massive numbers. Like 5.5% is not a terrible unemployment number. But again, you just went up basically like, 20% from the previous levels. VC funding completely dries up. Companies have to start cutting expenses, and there's a lot of layoffs. If you think about how this works, right, a lot of these companies are the demand for other companies, and so this starts reverberating throughout the economy. So it's a bit of a snowball effect. And then there's a really fun anecdote because Amazon is going to shift gears, and Amazon, more than Netscape by this point, is the poster boy for the dot-com boom. And Bezos famously publishes his letter to shareholders at the beginning of 2001, recapping 2000. And the first sentence he opens with, ouch. And he says, it's been a brutal year for many in the capital markets and certainly for Amazon.com shareholders. As of this writing, our shares are down more than 80% from when I wrote you last year. And then he goes on to say, we've set the goal of achieving a pro forma operating profit in the fourth quarter. While we have a tremendous amount of work to do and there can be no guarantees we have a plan to get there, it's our top priority. And every person in this company is committed to helping with that goal. So massive shift from land grab and growth to operational efficiency, cut expenses, basically become profitable.
And as we enter this part of the market, you're looking at 2000 negative 9% returns from the S&P, 2001 negative 12%. Nasdaq was down 37 and 33% 2001. One interesting thing just to kind of note, right, for kind of current times is gold didn't do anything during this whole thing, right? Gold just kind of sat pretty much flat throughout this whole expansion, which is very different than what's going on now. And then it was really 2002 that things were you had a major, so post 9/11, post all these accounting scandals, where you had complete capitulation with the S&P down 49% in 2002 and the S&P down 32% in 2002. And so that one of the deepest peak to troughs in a bear market period ever. But to your point, it wasn't that bad from just an economic perspective.
Yep.
You had real GDP growth of 2.5% and inflation averaged 2.5%.
Not terrible.
Not terrible. I mean, to me, the things that made it terrible in terms of the markets versus the economic data says it was 9/11 and the economic stuff.
And I think that's right. I mean, I think we didn't talk about this when we mentioned 9/11 a minute ago, but I think it's the right time to bring it up because I think there's a fundamental shift in people's mindset. And at the beginning, we talked a little bit about this concept of like the 90s are optimism and capitalism won and the Cold War is over and people feel safe and very optimistic about the future and technology. And ultimately 9/11 happens and it brings to everybody's mind that no, that's probably not true. Like borders still exist, violence still exists. There are people out there who are not signed up for this new world, who are very much opposed to it. And I think everybody, like the sort of cultural mindset shifts to a much more cautious, maybe somber outlook. And I think, it's pretty shocking, right? Like, I mean, where were you at 9/11? You were probably at school.
I was
8th grade.
in 8th grade. I think we were in homeroom, which would have been really early.
I was in homeroom too, actually. Yeah. You were in Connecticut. I was in Texas.
Yeah. And yeah, I remember just people being, in 8th grade, you don't have context for what's happening, really. But I did live in a place that was pretty close to where it was happening. So like there was that overlay of like, where are my parents kind of thing. But I remember there being just a lot, like I remember not being afraid, right, necessarily.
Yeah. Well, we didn't even know it was a terrorist attack until midday or later in the day, right? But yeah, I remember seeing the videos on the TV going like, what is like that is a bit shocking. I mean, certainly by the time the second plane hit, it was pretty obvious that this wasn't an accident. And then as if that wasn't enough, to wrap up 2001, everything is falling apart at Enron, which is kind of in and of itself a fascinating story, but kind of suffice it to say that several people started asking questions. Investors are growing skeptical of the business. Did you read this? There's a famous quote. You probably read it when, back in the day when you were reading The Smartest Guys in the Room, but there's a famous earnings call. You know what this is? Where this guy, Richard Grubman, questions Enron's accounting on the call. I can't remember the specific question. He asks, this is in April, and Skilling replies back with like thank you very much, appreciate it, asshole, which is sort of like the beginning of the end really for Enron. But, they're burning cash, ton of counterparty risk. They try to sign a deal with Dynegy. That doesn't work. And by the end of November, they get downgraded and they ultimately
file for bankruptcy. And at the time, it ends up being the biggest in U.S. history. Of course, this is all going to get way overshadowed when we do the great financial crisis with Lehman. But at the time, biggest bankruptcy. The next biggest is actually going to be WorldCom, which is coming in 2002. But it's a bit of a train wreck, and there's a ton of noise. People can't trust the reporting. Just like everything fell apart, right? Like September 11th, it's this big cultural question mark in everybody's mind and shift. Enron collapse, WorldCom collapse, questioning of leadership and executives and all these companies and what is real. And so now like people were already kind of running for the exits in the context of the dot-com companies and sort of the tech sector. And now it's like big time bear market at this point. Everybody's running away.
Yeah, it's interesting to bring it full circle where the cultural backdrop of the start of this whole thing was dominated by we've figured out how to govern the physical world with capitalism and democracy. Everybody agrees. It's very obvious. There are geographic boundaries. The internet's going to bring geographic boundaries down, and it's going to create this sort of new economy where we have a lot less uncertainty about the future. And when you put that in the context of 9/11, 9/11 pretty much blew all those things up, right?
Yeah.
Obviously, some people don't agree. Obviously, physical geography matters. And then most of all, right, like maybe some uncertainty about my inventory has been removed and that increases my profit margins, 3%. But like, to me, this is the kind of uncertainty that really matters in terms of like increasing or decreasing my profit margins so much that I go out of business.
Yeah, it doesn't fundamentally change the structure of business, not at this time.
And then I think one thing to talk about that you're probably closer to is like the regulatory fallout from two things. One, the accounting scandals, which was Sarbanes, right?
Sarbanes-Oxley, yeah.
And then second, we didn't really talk about this much, but like one of the big things going on at banks during this time, my understanding is that there was no Chinese wall, right? Like equity research and investment banking were not separated from each other.
Yeah, exactly.
And that the result of that was, very, very biased equity research.
Yeah, I mean, well, that whole thing, that whole concept of a Chinese wall comes about because of this. Because at the time, and there's a lot of books about this that I've read over the years where you study what was happening at the time, and to some extent, it seems like a lot of fun. Like all these research analysts that are publishing on these companies are not only like very intellectually invested in trying to do analysis the way that maybe they are today, but like they are actively participating in pitching, for business, and are actively participating in pumping up these stock prices the way that you might if you're like an M&A banker that is not responsible for research. Because, you want to be on the good graces of your clients. You want them to make money. You want to make money. You want to get hired for mandates. And so there is no concept of a Chinese wall. Like research analysts are all over these IPOs and the sort of like traditionally capital markets IPO teams that typically exclude now the research analysts. But yeah, the part of the regulatory aftermath of this is that the SEC incorporates a bunch of regulations as to how you need to manage an investment bank that has both, a trading team / research team and a sales team and an M&A banking team that has material non-public information. And then, of course, Sarbanes-Oxley, which introduces the concept of criminal liability for executives. So, if you're signing financial statements as an executive today at a company, like you're criminally liable if there's a accounting irregularities, and you can get prosecuted for it, which of course at the time doesn't exist.
Was that your? I didn't study this part that much. Is that the main change, or because I know that like so for example like this is where derivatives started to show up as a negative thing. This is where, a lot of kind of off-balance sheet financing things that I think were viewed as like risk transfer to the appropriate place prior to this, showed their faces like very ugly.
Yeah. The whole audit complex, like Arthur Andersen goes out of business because of their work for Enron. That whole complex gets restructured, and there's a lot more regulatory scrutiny that goes into what you can and can't do, what you can capitalize, how you should portray SPVs, special purpose vehicles, and off-balance sheet, debt. I think that's sort of the regulatory aftermath. There is one thing, though, maybe shifting gears a little bit in terms of the aftermath. When you look back, when you kind of sit back and reflect, a lot of the companies that kind of dominate the landscape today were either started or like completely restructured or like changed during this period, right? So like going through the list, NVIDIA, founded 1993, Amazon, 1994, eBay, 1995. Microsoft pivoted to the internet in 1995. So again, they were established well before that in the 70s, but they completely restructured the company. Arguably, actually, Microsoft had a lost decade until kind of the 2010s, late 2010s, but they were completely restructured towards the internet in 1995. Apple bought Next in 1997, so they bring back Steve Jobs. All of the operating system infrastructure that Apple builds after that is really next technology. So again, like Apple probably goes out of business if they don't do this deal, because Steve Jobs was critical in changing that company and bringing it back to health. Netflix, 1997. Google, 1998. The only major company today that wasn't founded during the dot-com boom is Meta, with the exception of maybe, like, we could talk about Tesla and like debate what Tesla is, but I feel like Tesla needs like its own separate discussion.
Netflix was a little later too, or no?
Netflix was 97.
Oh, was it?
Yep. And they were, of course, at this time, they're not so much a technology company. They're just delivering DVDs. But like the vision of, bandwidth increasing in Moore's Law, et cetera, and streaming eventually becoming a thing was already there. They were already talking about it back then.
By the way, I think I saw Netflix stopped their physical DVD business just like last year.
Yeah.
They're still doing like 30 million in revenue from that business.
Yeah, pretty wild. So, and I think the other thing worth mentioning before maybe we get into some insights and some lessons learned and maybe some questions we still have is that I think in the aftermath of this, there's this renewed appreciation for companies that actually generate profits and a big skepticism of new paradigm narratives. And I think what's fascinating about this particular cycle is that the internet being what it is and introducing this giant worldwide network of knowledge and information at your fingertips allows more people to be aware of this stuff. It doesn't eradicate, obviously, bubbles and cycles, but it sort of introduces the fact that they exist, whereas before it would have been a lot more of an unknown, a lot harder to discover these dynamics if you don't have access to all this information like right on your fingertips.
I want to know what you read.
Okay.
Tell me how you approached this whole thing.
Yeah. So my approach, I kind of used this as an excuse to really get deep into AI. And so I actually started, like the first thing that I did, I have read several books about this time period in the past, but it's been years. So the first thing that I did is I actually went on Perplexity and I asked it to find me the best books for this time period, which interestingly, there isn't as many as you would expect. Like I was expecting there would be like 10, 15 different books that would be fantastic for this period. And there really isn't. There's kind of a handful that are really good. And then there's others that are like on the fringe. So that was the first move. And then I got some of those books. The first one that I read was Origins of the Crash by Roger Lowenstein. And that was pretty good. It was like a pretty good intro. I'm not sure that was the best thing. And we can get into some of these other books that were decent. But the best stuff that I actually found through using ChatGPT's deep research. And so any particular topic, whether I was reading it in a book or an article, like this Fortune article from Warren Buffett, I would just start pulling on a thread and go deep into the rabbit hole and have deep research write me reports and, break it down into sections and include statistics, include as many sources as you can. And then I would go into the sources and like dig deeper into the trends of the data that it was sort of building a narrative around. And that was fantastic. That was really good. What did you read? What did you like?
I want to spend some time learning how you did that. So for me, there's probably going to be a couple books that I reference for every study we do. Just real quick, Secrets of the Temple.
You read that for this?
So it turns out it doesn't cover this time period.
Yeah.
But I'm just saying these are
That's a great book.
Yeah, it's a really good book. It's History of the Federal Reserve.
It's the Bible of the Federal Reserve.
I'll always reference Rise and Fall of American Growth. That's a kind of a book about the history of productivity. So it's not about the tech and telecom bubble, but it references it. Stocks for the Long Run has a lot of good data, and for this particular time period was like one of the kind of theological underpinnings. And then Financial Capital and Technological Revolutions is always relevant, and especially I think it was written in 2002. It was written right after this, kind of about this time period. And then I read pretty much. I mean, I spanned the gamut, right? I read Bill Gates' book from '95, which was not very good because it was just very old. I mean, one thing that's interesting is there's a lot of things in his book that he talks about that are just happening now, right? Like he talks a lot about agents, for example.
Yep.
And so I think there's an argument that like this technological revolution is like maybe seeing what Bill Gates saw in '95 is being completed now, in a sense. I read Mary Meeker's annual internet reports. I watched, the startup.com documentary, which was funny to watch because all the founders and VCs were in suits and ties.
Yeah, very different.
Very different than now. There weren't the best book I thought in terms of just data was .con, right? It was just a good comprehensive study by John Cassidy of the whole period. And the book that was the most fun to read was The New Thing by Michael Lewis, which is about Clark and just kind of his life and him as like the defining character in the period. And then I did a ton of market research, just kind of studying what did unemployment do in this period, where was consumer confidence, where was personal savings, and just kind of a bunch of like just regular way analyst stuff. But I came away surprised at how little good material there was about this time period in particular.
Yeah, there's not a lot. Even the book by Janet Yellen called, I think, the Fabulous Decade, I think is what it's called. And interestingly, that book, I mean, it was published in like 2001, so it's sort of like the crash is sort of materializing. But from a policy perspective, it didn't have some of the stories that I would have expected to see from a technology perspective. There's another book I should mention though to add to your list. One is called Capital Account, and this is the Marathon Asset Management book. And that book is fantastic because Edward Chancellor, who recently published The Price of Time, which is a really good book, has an introduction that's really good that sort of summarizes the whole thing. But then they have a bunch of letters that the Marathon team had written at the time, sort of year by year. And so it's a really good one. I think it's particularly good to understand what was happening with the capital cycle, more broad. That's not just for this period, but it's sort of like a framework. It's called Boom and Bust. So it's a good one that I'll probably keep referencing as we keep doing this.
Yep. I did read. I also read Boom off your recommendation.
Yep.
Right. That's just about bubbles.
Yep.
And I read the John Malone Cable Cowboy book, which wasn't super. So like that was again an interesting story about a guy, but not super educational.
Yep.
And yeah, your reference of Marathon for me, like lots of takeaways and lots of questions. Your reference of Marathon's one of the big takeaways for me, though. So my understanding of what Marathon does is they take like a Warren Buffett approach, but they consider capital flows like a lot more strongly than anything else. And so that's one of the big takeaways for me, right? Like you got to consider the capital flows, right?
Yeah.
Like where's the money coming from? Who's it coming from? Where's it go? What are the demographic kind of forces of that? And all that kind of stuff was one of my major takeaways. Just like where because just a complete tidal wave of capital was unleashed from retail investors into the market during this time period that drove the stock market. So that's kind of one of my main takeaways.
Yeah.
And in addition to that, you got to find a way to watch the IPO market. One of my questions that I'd love to review is like, how does a regular person do that on a day-to-day basis? I'm sure it's doable. Like, how do you know if Netscape went public and it was 10x oversubscribed and traded up 100% on the first day?
Yeah.
How do you stay on top of that? Kind of where the IPO markets are.
I had three that I think were very significant. The first one is that history rhymes. What's interesting, and part of the reason why we chose to do the dot-com first, is that there are similar dynamics playing out. We can talk about this. I don't think it's identical. I think there's some analogies and patterns that are similar, but I actually think it's a much healthier market today. And of course, you're not seeing this play out as much in the public market because a lot of these companies are not going to go public. And even companies that have been around for a while, like the Stripe and SpaceXs of the world, are staying private for much longer, and private markets are much deeper. And so, maybe arguably there's a bit of an overvaluation of a lot of these companies, especially SaaS companies that are non-AI, and they're having a hard time figuring out what to do next because they should probably go public, but their last valuation was really high, and it would probably be effectively a down round if they went public today. And so they're choosing to stay private. They're between a rock and a hard place. But history rhymes. That's my first takeaway. The second one is that everybody, in these technological sort of paradigm shifts, everybody will extrapolate from the current dominant models. So the case in point is that everybody expected the browser to potentially be the next Windows, the sort of Windows killer, the next operating system, the next platform, and it really wasn't. And so it sort of begs the question, and now entering the age of AI, back then, what ended up actually being the dominant platform was search. And towards the end of this, we didn't really get into it too much. There were several search companies that were in the running. And, Google was not a foregone conclusion. And there's reasons why they won. I mean, the tech was better. The PageRank algorithm is much better. But they also did things from a fundamentals perspective that were much better, which is my third insight. What do you focus on when you evaluate companies through a technological paradigm shift like this? And I think my main takeaway from this is that you have to look at real demand. I mean, think that the vision of the dot-com boom eventually does become a reality. Like the internet does change everything. And these companies do end up being massive. And ultimately, like that vision plays out, but it takes a lot longer. And that demand was just not there at the time. And so prices definitely outran revenues and real growth, and unit economics were just not even talked about back then. You mentioned Priceline. Like Priceline was spending more to acquire the tickets that they were selling than what they were getting paid from their customers.
And so you have to focus, when you're looking at individual companies, you have to focus at companies that have real demand, real traction with customers, and you have to look at competition, and you have to look at the leadership of these companies.
To my point earlier, I think you could have looked
on and said, this is a real business, and this thing really has legs, and this leadership team is relentless, and they're really going to be a survivor. Begs the question whether or not maybe you should have bought them at the IPO level, because massive drawdown afterwards. But nonetheless, like, great company. And if you had held at that time, you're over 1,000%, through like the 2015, 2020 time period. And then markets in general, just understanding base rates. Like, it all comes back to base rates. Like, thinking of that Buffett article, if you constrain yourself to what is actually possible, what is structurally possible in an economy, then you at least have a sense of rationality and can kind of keep an eye on what is real and what is probably hype. Those are kind of three.
Yeah, one thing we didn't talk about, when Greenspan was raising rates, one thing he said, I think when they raised rates above the 98 levels, was he said, this doesn't mean that asset prices can't go up, but it just means that they should go up in line with income.
Yeah.
And income had been going up at like 5 or 6% a year, versus the Nasdaq was 100% the year before. So it's like a super. It's kind of a similar comment on like, what
it's not grounded in
what are the real constraints for markets, and how long can you be outside of those constraints.
Okay, what are some questions do you have? So if we had somebody here who the guys from Marathon, or somebody who had lived through this period, who'd been super thoughtful about it, what would we want to ask them?
I mean, we talked about how there's like a little bit of uncertainty of like why the bubble popped, right? So like it's kind of a mix of things, but for someone that was there, I'd be curious if it was like clearly rates or clearly some of these articles, and just understanding the impact of 9/11 versus accounting scandals, and how those played into like the length and depth of the downturn would be interesting. The yield curve did some pretty interesting things that I'm not sure I understand throughout this period, so I'd be curious to ask about that. I'd probably mostly just try to dig in on. I'd use it as a chance to understand productivity better, right? Because that to me, that's like the headliner of this time, right? Like, bubbles come and go, but this was the last time period where we had like some pretty interesting productivity enhancements, and so kind of digging in on what caused those exactly, and why didn't they last very long, and like what is the opportunity set for increasing productivity today, right? Because when you think about growth is just demographics plus productivity. I think demographics, we know, I think the replacement ratios currently, like, I know it's sub 2.1, which is what we need to sustain the population in the US. It's better than a lot of other countries, better than most other countries. And I actually didn't realize it wasn't that much lower than it is now in the 70s finding. And so like, I don't think we're going to get a big, it doesn't seem like we're going to get a lot of GDP support from demographics. And so it has to come from productivity. So like, what is that? What are the possibilities there? Would be kind of like what I would try to analogize for today, would be what I would focus on if we could get somebody who was around then and knows these things well.
I think I would add two things to that. I think one of my main questions is, how do you navigate as a professional investor, not a retail person maybe, but just a professional investor that has to be held to a benchmark and that is competing against other investors chasing AUM and chasing the same dollars for managing. How do you navigate this period in a way that doesn't put your business at risk? Because ultimately, if you're sitting there in 1996, 1997, and you're worried that this is a bubble, you're worried that if you're looking at the fundamentals, you probably shouldn't be buying into this market. How do you make that decision and manage capital in that context without just getting crushed, without not being able to raise another fund, right? Because you're going to be underperforming. And so that's I would love to hear from somebody who's like navigated this period as to how you might go about it. And then the other question I have is, when you think about technology and sort of like big time technology movements, and we're certainly going through one now, not everybody can be Warren Buffett and say, I'm not going to invest in technology companies, right? And so then how do you determine which of these companies is Amazon and Google and which is Webvan and Pets.com? And I think simplistically, in hindsight, it's easy to tell like which ones are good companies and which ones aren't. But at the time, the fog of war is such that it's much more difficult to have conviction that one company is going to be much better than another. And so I would definitely want to dig into that a little bit.
One other thing before we close that I would also love to go learn, that probably wouldn't come from just kind of like zooming out and thinking big pictures. My take on like what sort of kicked off all the computer stuff after World War II was Vannevar Bush. For some reason that I would love to learn, was like most concerned with information overload coming out of World War II, and how it was going to be impossible for people to navigate all the information. And I would love to understand why that happened, right? Was it because of World War II? What caused an information explosion?
I would love to dig into that too. It's interesting because those guys, him and Licklider and some of these people that were thinking about this stuff pretty deeply, were very prescient if you look back at what they were writing and some of the speeches that they were giving. So yeah, I would love to dig into that too. Okay. Should we leave it there?
Let's wrap it up.
All right, let's wrap it up.
Good talk.
See you soon.